This snowflake analysis is enough for me to make a decision. This snowflake analysis. Why? Because I can see future prospects of the company, not great. Past performance, not great. Financial health, not great. Value, dividend. They seem to be doing well in dividend. So it's one of those companies that pays dividends. But if you look here, this is part of the analysis now. See, here it says risk analysis. This company pays 9.43% dividend, dividend of 9.43%, yes, is not well covered by earnings or forecast to be in the next 3 years. So what that is saying is they are paying a huge dividend to their shareholders, but looking at their earnings, they will not be able to continue to pay that in the future. And why is that? Look at this next point. This company is unprofitable and it is not forecast to become profitable in the next 3 years. So that gives you some idea of the company's performance. Market performance. Well, let me check. Hold on. It says 0%. Let me check the ARTC. Let me check the ARTC. ArabTec Holdings. Wow. Look at the stock of this company. Put it on weekly. Right. Look at this company. Look at this company. So this company IPO'd at this price. That was 15, I don't know what the currency is, dirhams. So it IPO'd here. And then there was a lot of hype for whatever they're doing. Price went up, didn't last long, crashed. Now imagine if you were one of the people who bought here. 59, let's just call it dollars. Imagine if you bought there. So, wow, this company IPO'd. Wow, I am an investor. Let's buy. Price is going up. It goes up. It goes up. It goes up. You buy here, and it continues higher. Wow, this is a good investment. And then what happens? Crash. That crash took place in just a few months. Crash. And since then, it has not been able to get back to half the price of its all-time high. Look at where price is now. It's like a penny stock, 0.5. So you're probably stuck with your stock, or you're stuck with your share. All right, back to fundamental analysis. 1 year return. So if you bought 12 months ago, you're losing 72%. Compared to the construction industry in United Arab Emirates, where the stock company is located, just minus 11%. Compared to the overall stock market performance in United Arab Emirates, minus 6.6%. So this company is performing worse than the stock market in Dubai and worse than the construction industry in that country. Not good. Its share price is very volatile compared to the industry and the market. Okay, what about its valuation? Let's try to value this company. This company is trading 176% above its fair value. That is using discounted cash flow analysis. Remember, you want to buy when the market price is lower than the intrinsic value, so that you can take advantage of the growth and the overvalued increase. So let's go down. If you look at its price to earnings ratio, okay, that's just a ratio, another way to look at the value of the company. That is, we're comparing the price of its stock to the total amount of earnings the company has. This company, well, the company is unprofitable, so you can't really calculate that. It's not making any money. Future growth. How is it forecast to perform in 1 to 3 years? Okay, look at earnings and revenue growth forecast. So this is not even, see, at some point, revenue was high, and since then, it's been down. So revenue is forecast to decrease. What about earnings? Earnings refer to money the company is making, money coming in. Okay, so initially it was making a loss, and then between 2018 and later part of 2019, it made some money and then back into loss making. And then it tried to make money but was unsuccessful. Now it's making a loss. So the reason this software is good is it shows you everything in it's a visualization platform. It shows you everything using nice charts and tables and graphs. Okay, let's leave that alone. Go down. Growth forecast based on analysts. Okay, now when you see this in Wall Street, there are some people who are paid to monitor certain companies. So these people are called analysts. For example, if I come here and I click on estimates. So you want to trade a company that lots of analysts are watching, okay? Not necessarily all the time, but it's an indication of a company that is worth paying attention to. So for Apple, you have, let me add this up. You have 17 plus 7 plus 11 plus 1 plus 2. You have 38 analysts monitoring Apple. 38 analysts are monitoring Apple. 17% of them say it's a strong buy. 7% say buy. 11 say hold your position. Don't buy more, don't sell. One of them says sell. Two say strong sell. So this is an indication of sentiment. We're going to talk about sentiment later. It's telling you what people who are paid to study this company, what they think. So out of 38, 24 say buy. 11 say, okay, don't buy more, just hold what you have. And 3 of them say sell. Of course, you can ignore the 3 of them. So it's the same thing here with this, where is that? With ArabTec. So these are estimates made by analysts. So analysts are saying this company is forecast to grow in the future. Okay, it's going to grow in earnings. Okay, earnings. Revenue, however, is down. It's going to grow in revenue, but compared to the industry and the market, not by much. So that small amount of revenue growth is going to generate this amount of earnings. Sometimes analysts are wrong, sometimes they're correct. Depends on how much faith you have in them. Earnings per share, you need to Google what that means. So there's so many things to monitor here. So you can't monitor everything. You just need to decide what are the most important metrics for you when you're analyzing a company. And those are the metrics you pay attention to. There's too many here. Past performance. Past performance, not that great. And past earnings growth analysis. It's just bad. Terrible. See that? 928.1% negative. Returns on equity, they're comparing the company to the industry. Financial health. Okay, I like to look at this one. Short-term assets are less than short-term liabilities. Long-term assets are better, higher than long-term liabilities. So this is a summary of what is coming from the financial statement. Now look at this, debt to equity ratio. You can see the debt is increasing. See that red line? It's increasing, far greater than the equity now. You don't want to see that. Dividend. See, I was talking about dividend. This company this company's dividend is higher than the bottom 25% of dividend payers in the United Arab Emirates, and it is in the top 25% of dividend payers. So if you're investing in this company, you're not trying to take advantage of price movements, because if you look at the price, it's terrible. See that? Down. You're not trying to take advantage of price. In fact, you might be losing money if you invested in this company. You might be losing money. So the only form of investment that makes sense in this company is to invest for dividends. Why? Because this company will pay you dividends. You see these blue lines here? That's when they pay their dividends. Blue lines, they pay dividends. These red lines are when they announce their earnings. So this company is only good for the dividend it is paying. That's a good dividend yield, 9.43. You can see it is higher than the market top, higher than that, higher than the industry average. And it is forecast to grow, even though they don't have the money to maintain it. Stability and growth of payments, not looking good. What else? And you can look at the leadership team. How old are they? Who else is on the team? How long have they been there? Who are the board members? How long have they been there? Who owns the company? Well, no data on that. Ownership breakdown. General public owns 52%. Sovereign wealth funds, 34. Private companies, 10. Institutions, 2. Top shareholders. These are the top shareholders in that company. So that's just a brief analysis of ArabTec.